Hi guys, I'm Karunya Rao, and in Ideas for Profit, the spotlight is on India's largest car maker, Maruti Suzuki. The severity of COVID's second wave dented the Q1 performance of Maruti on a sequential basis, and the car maker's financials have seen a deterioration across performance verticals. A decline in demand along with commodity cost pressure impacted the overall show for Maruti this time around. The wobbly performance of the company also affected the Maruti stock price, which has now fallen 15% from its Jan 2021 high, making its valuations quite reasonable. During the first quarter of this fiscal, Maruti's volumes declined 28% QOQ on the back of a steep decline in demand because of surge in COVID cases and the subsequent lockdowns. Realizations, however, improved by 3% sequentially, primarily because of the price hike that the company took to pass through the increase in raw material prices. Discounts also remained quite subdued during the quarter gone by. Apart from the decline in demand, of course, it's the raw material prices which dented the overall performance. Margins for Maruti in quarter gone by contracted 370 basis points on a sequential basis. Staff costs also impacted the margins as the company had to incur multiple one-time expenses for treating COVID-infected employees. The third and the fourth quarters of FY21, which is second half of last fiscal, saw a significant demand recovery, implying that the nationwide lockdown following the first wave of COVID-19 drove pent-up demand for cars. A similar scenario can emerge this time around after the second wave as well. With a significant reduction in COVID cases, demand can rebound sharply. In fact, the management has indicated that footfall and inquiries have risen quite significantly in July 2021. Moreover, increased vaccination and a reduction in fresh cases are also expected to boost customer sentiment, thereby improving the overall demand picture. What could continue to work in the favor of the company is the preference for personal mobility as people continue to avoid public transport even now. Management expects Maruti to be a major beneficiary of this trend as it is the market leader with a huge network. It's well placed to garner the bulk of the increased demand. In fact, the company's management also highlighted that it expects demand to pick up both in urban as well as rural markets. With a good crop production, normal monsoon, the rural sentiment should remain positive in all likelihood, which should benefit Maruti given its strong rural presence and penetration overall. Other factors that can contribute to a rise in demand are lower interest rates, easing financing, and a pickup in economic activity with the easing of lockdown. However, with the apprehension of a third wave, the situation remains quite volatile. It needs to be monitored quite closely. Should that happen, the company would be adversely impacted. On the whole, we expect demand to remain robust for a long-term perspective. It can, however, get impacted in the near term because of COVID-related disruptions. The steep rise in raw material prices will continue to hurt margins. Higher commodity prices, especially that of palladium and rhodium, will have an adverse impact on the company's performance and financials. Also, with the steel prices moving up, Maruti expects gross margins to remain under pressure. However, the company, like I flagged off, has taken a price hike to pass through part of the increase in raw material costs to the buyers. The management also highlighted that margins could be volatile even in the second quarter of FY22. Additionally, the ongoing shortage of semiconductor chips may impact the production of the company. On the back of the uncertainty triggered by the second wave of COVID pandemic and the apprehension of a demand slowdown, Maruti's stock price has fallen 15% from its 52-week high that was seen back in Jan 2021. Valuations now look reasonable at 31.2 times of FY23 projected earnings. Therefore, we advise investors to accumulate the stock in a staggered manner during this soft patch. Of course, one must watch out for some risks as well. Any slowdown in demand due to COVID will hurt the company's financials, so will rising raw material prices. So important to keep an eye on those factors as well.